So let's get more on what investors should expect and bring in Mandy Su, the Credit Suisse Chief Equity Derivatives Strategist. Mandy, great to speak with you.
Thanks, Melissa. Great to be here.
To Guy's point and to Steve Leeson's point, I mean, the notion that the Fed will say that it will allow inflation to run hotter than it had in the past, and the fact that there is really no inflation out there, I mean, that seems like it would be extremely friendly to the markets.
Yes, so I would agree. So I think to go back to your previous point about how there hasn't really been inflation any time in the past, 10 years, keep in mind that even though there hasn't been inflation, the Fed had been hiking, right, between 2015 and 2018. So I think this is just the Fed telling the market we're taking inflation much more seriously, and more than that, we're taking the lack of inflation more seriously, and we're going to be on hold for much, much longer this time around relative to the last crisis. So I think overall, this is a dovish development. If they do switch to a average inflation targeting framework, it is dovish for the market, but I would say incrementally so, because a lot of this has already been priced in, and also because what is driving market right now, what is the source of uncertainty, it's not really on the monetary policy front. It's much more on the fiscal front. So I think investors understand, markets understand, the Fed's going to be there. The Fed can be more dovish if need be, if things get worse. So incrementally, nothing really has changed on that front. But really where the source of uncertainty is right now is more on the fiscal side.
So given the way you view the Fed backstop at this point and the uncertainty of fiscal policy, what does that mean in terms of what the trade has been, specifically growth over value, and does that remain intact? I mean, the Fed would say, yeah, absolutely. I mean, if you believed in the Fed backstop, that growth is a place to be because rates are going to be near zero forever, practically forever. But if you believe that there could be some risk from the fiscal side of it, I don't know, maybe that goes out the window.
Yeah, so I do think this plays into the recent rotation that we have seen. I would say part of it is driven by this low rates forever being beneficial for growth stocks. But partly, I would also say, over the past 2 weeks, we've seen a pretty severe underperformance of value. And that is a sign that investors are starting to doubt the durability of this recovery, right? Without a fiscal deal, without more stimulus money coming, I think there's now more risk to the economic recovery going into the end of the year. And that's why I think tech is outperforming, because tech and growth stocks in general are more insulated from the pandemic-driven economic weakness that we have seen. So to me, if we don't get a fiscal deal, if rates stay low forever, basically, then that should be another tailwind for growth stocks going forward.
Hey, this is BK. I have a question. I mean, we've all assumed that the Fed cannot manufacture inflation. But there have been some things that have happened, particularly interruptions to supply chains, some supply disruptions that are creating price increases. So if we do actually happen to get inflation and the Fed is printing money, what does that do to growth stocks? I mean, doesn't that inflation erode their earnings? And wouldn't that actually be bearish for the market rather than dovish?
Yeah, so I mean, you're right. So there's definitely been, supply disruptions, but I would say right now this crisis is much more on the demand side, right? We have double-digit unemployment. We have, record disruptions in service industries. A lot of, I would argue it's much more of a demand-driven economic weakness, in which case it's actually relatively deflationary. But certainly, if we do get a sustained pickup in inflation, I think that would force the Fed's hand, and that would, on the margins, be negative for growth stocks.
Mandy, great to speak with you. Thanks for your time. Mandy Su,
Thanks.
Credit Suisse. Tim, your thoughts on what we could expect from Powell?
I think you're going to hear more of this, dare I say, garbage on symmetric inflation and where they're going to allow for an inflation overshoot. Like most people here, I think there is inflation. Inflation break-evens are higher. I also think the notion of the Fed not creating asset bubbles with monetary policy is one of the most absurd things I've ever heard. In fact, since bailing out long-term capital in 1998, all the way through to where we are, the Fed has created the asset bubbles that have created the crises. And so I don't think that the Fed really knows how to get out of this situation, even though they think fundamentally they can assess this. So bottom line, buy equities. Buy equities as long as the Fed is in accommodative mode, and run for the hills the minute you hear a whiff that they're actually changing their policy.
Yeah, FYI, Pete and BK are nodding their heads yes in agreement, because we don't have the desk here, so you can't see all these guys, but they are. So that's where we stand.